Please note that the information on Retire Vivid referenced in this video is accurate as of March 29, 2024. Changes to laws and regulations may make portions of this segment outdated and no longer relevant. Information presented is for educational purposes only and is not intended to provide investment, tax, or legal advice. Please see our full disclosure at the end of this video.
Welcome to Retire Vivid. I'm McCarty. That's Tommy Breitbach. We're both financial advisors. He's also a chartered financial analyst, or a CFA. This is right up our alley today, Tommy. And so what we've done today is we've compiled 10 different investing mistakes just to give our viewers, some things that we've seen or maybe what they've experienced, Tommy. So let's dive in. So the first one is having unclear investment goals. Tommy, let's start with that because, if we don't know where we're going, we're going to end up somewhere totally different.
Yeah, generally I would say most people invest and save planning for retirement. It's a long-term process when you're starting out. And so at some point in there you move kind of to an accumulation phase, and then maybe middle age you're balancing investing and saving. And then you hit retirement or very near retirement. You're at an asset level you've accumulated, and putting that plan in place to take you from retirement through however long you are retired.
You're right. As we age, our plan changes. And I think that's why it's so important to have a clear investment plan. And I think that we do such a good job of that with clients in terms of going, okay, do you believe in the philosophy, or what is your philosophy of your overall investment plan? What strategies are you going to use? And then also, what individual securities are you going to own to accomplish that goal? And so I think that's one thing that we like to do is we use a risk number. And so it's so nice because, as investors, the sky's the limit. You can invest in anything you want to invest in. So for example, let's just say that you have a risk number of 70, okay? But yet your portfolio has a risk number of 40. Well, no wonder you're not happy with your portfolio in this case, because you're going, hey, I'm at a 70, my portfolio's at a 40. It's not getting up there with me. But then let's flip it. Let's say that you have a risk number of 40 and your portfolio has a risk number of 70, Tommy. You really, you'll be happy in the up markets, but you won't be happy if we go through a stock market crash, if you would.
Right. Most people aren't worried about making too much money.
Right.
In your example, where your portfolio is a 70, but you're only a 40, you tend to find out kind of at the bottom or when the market's down.
Right.
You find out you're wrong.
Find out you're wrong.
Find out you're wrong, and that's where mistakes are made.
Yep.
So that's why it's so important to, sit down, and if we're here talking about kind of retirement or near retirement, you have your asset level, you're going to have different sources of income, putting that plan in place, defining what you want your assets to do. Are you still seeking to grow, or is it purely income? Whatever you want to do, but having that plan in place and making sure that everything is going in the direction you want to.
Well said. So now let's move on to the next one. Now, I think this one comes up a lot. It's constantly watching markets.
It's really important to be, long-term focused. Investing, saving, retirement, hopefully it's a long time for most people, but you need to be near-term aware. We've been through some volatile times over the last few years, and it's really easy to get caught up in the day-to-day movements and, are markets up or down any given day, or are they up and down for a few weeks in a row, or, getting caught up in everything you see on TV or the news or social media, all those pieces, but maintaining, going back to having that investment goal.
We watch markets every day, and it drives us nuts, right? It's
So,
constantly moving.
Day to day, there may not be a rhyme or reason in there for what's going on.
Right.
But that's why it's so important to have that long-term focus.
Well, and that's what we are. We are a wealth management company. This is what we get paid to do, right? This is what we get paid to do. Because again, we have a plan. We want to stick to that plan. Now, of course, we have to make adjustments. If there's some different economic events, political events, or black swan events, if you would, of things that change, that makes us need to move. Because again, a lot of our clients are retired or close to retirement. And so it's important that that portfolio, meets their overall plan.
We touched on it on the first one. You're mentioning market events, but you get in, people have things happen in their lifetime that may change what they want their assets to do, what they need them to do. And that's why it's so important to have a long-term goal and make sure the plan is continually monitored and you're sticking with it.
So I think the next mistake that we see, in terms of constantly watching markets, I think it bleeds into the next one. Letting your emotions get in the way, Tommy. Our clients and our viewers, have worked extremely hard for their money. You worked hard for your money. And we all have an emotional attachment to your money. And so it's just natural, right? So if you're seeing your portfolio getting hurt, right, what's the first thing you want to do?
Stop the hurt.
You want to stop the hurt. You want to save it, right? You want to pull it into the boat. But in fact, that could cause an issue there, right? Because our emotions, investing is like the psychology of money.
It really is. The investing, the market, it can move like a roller coaster at times.
Right.
And so you never know exactly where you're at, but that's why we always harp on the long-term focus. Markets over time tend to go up, but as you near and enter retirement, it becomes more important in the sequence of returns, and that you're being smart with your plan.
Let's dive into this, Tommy, because let's talk about the wave of emotions, if you would, when it comes to investing. So take a look at this. So when we start investing, there's optimism, and we're also excited about it, and then we're thrilled because we're making money, and you see that the market's moving up.
Yeah, things are going their way, and then that tends to be at the time everybody's really excited, maybe too excited. You kind of hit the
point of maximum risk,
yeah,
right?
You hit the high point, and then the market rolls over,
yep.
And you're balancing the focus of is it down just a little bit and going to come back, or is it still going down? But as you're following through, denial, anxiety, fear, and then at that point, more losses happen.
More losses happen, depression kicks in, panic, right? And that's where people break the cardinal rule, right? Buy low, sell high, where they're actually doing it in reverse, right? It sounds simple, but yet when you're actually feeling it and you're seeing it, people don't do what they're supposed to do. And then Tommy, let's keep going there, because we also have that point of despondency.
Yeah, it's just, you never know exactly when the bottom of the market is, but at the time, people tend to not be able to take any more. It's sometimes a good time to invest, and then, the market starts turning and people are a little skeptical of it, and then you hopeful, and then you're,
and then where are we back at, Tommy?
We're back to optimism.
We're back
again.
to optimism.
Right back to optimism. You can't stop the wave, but you can learn to surf.
That's a good that's a good way of putting it. But you know what though? For a lot of people, the market feels like an escalator going up and an elevator going down. Some people can feel that way. But that's why you work with a coach, right? Or a financial advisor to help you through this wave, to get you to keep you on track with your overall plan. So next, we're going to be going through the next investing mistake. Stay with us right after the break.
Do you have questions about your retirement plan, or do you want to know if you are on the right track? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to make retirement vivid. Schedule your 15-minute retirement review today.
Welcome back. If you just joined us, we're talking about investing mistakes, and this next one, Tommy, is chasing trends. Sometimes it can feel like a craps table, right? You see all these people, they're hooping and hollering. You know, you want a piece of that, right? And so with FOMO kicks in, the fear of missing out. But by the time you get to the game, you might be the one holding the bag, right?
So you don't want to be the last one standing there when all the fun runs out.
No, you want to be there when all the winning's happening, right?
That's right. Yeah, and it's really important. We're in an age of just instant news. You got social media, news, internet, all of these places you can get information from. And so it's really important to understand the motivation of where you're getting that news from, and what their investment profile is. Are they day traders? Are they looking for something that maybe doesn't fit with what you want to do?
Right.
And that's why it's so important we talked about in the first one, having a goal, and defining that plan and sticking with it.
Yeah, I mean, one thing I appreciate about what you do, I mean, we get a lot of independent research, because like to your point, Tommy, there's a lot of noise out there. There's a lot of noise out there. I mean, especially from what you're getting from the news. The question is this, is when somebody's telling you to buy something, right? If they're a professional, whatever, my question to them would be, are you actually managing people's money? Where we are. I mean, we're managing people's hard-earned money versus somebody that's not and just saying, yeah, go buy this stock for whatever reason it may be. So again, cutting through that noise.
There is definitely a different aspect of, just saying, no, this stock looks undervalued on numbers, versus sitting in front of somebody and working on that retirement plan or the investment plan.
And so let's move on to the next investing mistake. And this one is, there's a lot of truth to this. It's not giving your investment time to grow, because I think so many times, Tommy, people it's natural. We all want that instant gratification from our portfolio, saying, hey, I'm going to be in this investment right now and I'll make all this money. Well, that's not how it works all the time.
That's not how it should work either. You're looking at saving for however many years and then being retired for another 10, 15, 20 years, hopefully. And so it's a long-term process. You're not looking for that instant gratification.
And I think it also comes back to your point from our first investment mistake, is having that plan, right? Because again, what we do is you want that philosophy behind the overall plan, which securities that we're adding into that strategy to meet our overall investment goals for the future.
Pushing yourself to trade or trading too often can take you out of a good stock or a good investment, before it has time to realize its full value.
Right. And to your point, I mean, don't in terms of don't pushing yourself to trade, don't trade for the sake of trading. Right?
That's right. Maybe maybe one of the most successful or most famous investors of all time, Warren Buffett, he said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And then, when he purchased, he allowed the time for that investment to realize the value he was looking for.
That about sums that up. I mean, what a great point there. And so, now let's keep moving. So let's move on to the next investment mistake. So this one here is delaying investing altogether. And Tommy, there are people out there that the stock market just isn't for them. And so let's talk a little bit about that in terms of, because again, people want peace of mind, and I respect that and I get that. But, why are we in the market? To grow wealth, right? That's the reason why we all go into that. So let's dive into this mistake.
There was a great example put out by Charles Schwab, their Center for Financial Research, and so they showed 5 individuals here that invested $2,000 annually in the S&P, or portfolio that tracked the S&P from 2003 to 2022, and we're talking about when to invest versus not investing at all. So. This first individual, Peter, he was a perfect market timer. He happened to buy at the exact low mark of the S&P each year.
Lucky.
Ashley realized that she was not going to pick the perfect time to invest. And so she put her money in on the first trading day of each calendar year. Matthew said, nope, I want to spread mine out a little bit. He split that $2,000 up and invested equal portions, every month, kind of like your 401k contributions, where you put it in per check. Okay. Just put the money in. Rosie was a terrible market. She was the exact opposite of Peter.
Exact opposite.
Exact opposite of Peter. She just happened to buy in each of those calendar years at the high mark of the S&P each year. And then Larry over here didn't want to be in the market. He was just convinced he never found the right time. And so he just put his money in, basically short-term treasuries or kind of a cash equivalent. Mm-hmm. So you can see just the numbers. Even Rosie at just the high of each year over that 20-year period, she ends up with, about $112,000. Peter was perfect, ended up with $138,000 compared to Larry down there, just at $44,000. It just shows the importance of, not trying to pick the perfect time, just go.
Just being in, because there's also something else that we got to deal with, inflation, right? And also we don't want to lose purchasing power, right? Because again, like that's just a great example. Like a lot of our clients are retired or close to retirement, and a lot of them are pulling from their portfolio. Well, we got to keep up with the cost of living, inflation, you name it.
Yeah, we mentioned it a lot this episode, but that plan and those investment goals, having everything aligned and something you can be committed to and stick with.
Well, that was a good one. So now let's move on to the next one, and I love talking about this one. This is expecting maybe too much or using someone else's expectations, because how many times, Tommy, does somebody come into our office and say, hey, this person's making this, I want that. You don't know what this person, how aggressive they may be. So, if you want those bigger returns, you may be having to increase your risk tolerance in order to get there, which also means if the market turns, right, you're going down with it.
Well, it's a lot easier to talk about the gains than the losses. So
right.
Make sure if you're in that situation, you're getting both sides of the story. But yes, everybody is unique. They have, their own income sources, their own assets. They have, an individual risk tolerance. And so it's really important that your plan is tailored to you and it's something you could commit to. We talk about investing over the long term or, having a plan for the long term. But it's really important that you're committed to the plan you have in place.
That's such a good point. So Tommy, let's turn to our viewers. If you have questions about your retirement or maybe this topic with your portfolio, give us a call. We offer a 15-minute retirement review. We are truly here to help you answer those questions and get you pointed in the right direction. Next, we're going to talk about the final investing mistakes. Stay with us right after the break.
Retirement planning can come with more questions than answers. How do I save money in taxes during retirement? When should I file for Social Security? And how do I retire my 401k? With so much to plan for, how do you know if you're making the right decisions? We are here to help. Join our upcoming retirement class by going to retirevivid.com, where you can choose the setting. Whether you want to be at home listening online or if you want to see us at an event, it's up to you. We are here to help you get retirement ready. Redefine your retirement journey today.
I'm Cameron McCarty, talk show host, financial advisor, and business owner.
Did you know Cameron is happily married, raising 4 kids, thinks he's a news anchor?
I don't know about that one.
But did you also know he helps people get retirement ready? He can help you too.
That's why I'm coming to you on the weekends, getting you answers to your retirement questions.
Don't miss him on Retire Vivid, every weekend on ABC.
Welcome back. So Tommy, we talked about a lot already. Let's wrap this thing up with a bow. We got 3 more investing mistakes. I think the next one's actually a good one. Trying to time the market. Let's call it what it is. It's nearly impossible to do.
It is nearly impossible. And it's really important that when you are investing, that you are in control of, the budget, the B word. Being realistic with how you spend your money, planning for maybe upcoming larger expenses. It's really hard to try to access funds, if the market is down. And it's really important to have building up that emergency fund, having those reserves available for unexpected expenses.
I'm really glad you said that because, that's what we focus on with our clients because, again, a lot of our clients are retired or close to retirement. So we need to have that reserve because I can promise you this market will be volatile during the course of your retirement. But Tommy, that's where that peace of mind comes in, where when the market does, just like we talked about with that wave of emotions, when you start to see that market go down, you're okay because you have those reserves. That's why it's so important to have that, because the last time I checked, you worked hard for your money. Extremely hard for your money, which goes back to the initial thing that we just talked about at the beginning, having a plan.
That's right. Short-term focus, but long-term aware.
Absolutely. So now let's move on to the next one. Let's talk about this. This is important because, again, when it comes to investing, there are fees involved. And maybe if you're working with someone or whatever it may be, it could be also commissions, Tommy, but this can be a mistake as well too. So let's talk about this one.
Fees, commissions, any of those things, they are a drag on performance.
Right.
It is money coming out of your ultimate return. And so it's really important that you know what you're invested in, what fees and expenses you're paying, and that you are getting the value out of those, for what is going in.
It comes down to the product that you may be invested in, or like a mutual fund or whatever it may be, right, for owning that product, or maybe even the advisor. I mean, are you paying the advisor as well too? And so one of the things that I pride ourselves on is, are we a wealth management company? Yes, but we do more than that. So we focus on retirement planning, Social Security planning. I mean, not just wealth management is where I'm getting at here in terms of that, in terms of encompassing that full plan into one.
It's really important that you know what you're paying and that what you're invested in, the fees you're paying, all of those things, match up with your investment goals, your financial planning goals, and what you're getting out of it.
And Tommy, I mean, as a consumer, the sky's the limit in terms of what you can invest your money in. The question is what makes sense for you? Because think about it. We've got ETFs, stocks, mutual funds, annuities, you name it. The question is what do you do? Just real quick. ETFs, what's an ETF? It's an exchange traded fund. One of the things that's nice about it is they can be cost effective, the trading aspect of it, and also potentially some tax efficiency there. So that's what's nice about ETFs. Let's talk about stocks.
Yeah, an individual stock, you own, one company in that individual stock. There's no expense ratio associated with that.
Which makes it nice.
But you are, again, owning that one company.
That one company, which leads into that we want to be diversified, right? So, but again, that's just one stock. And then we got mutual funds as well, too. Let's talk about those.
Yeah, mutual fund, it's a pooled investment, so kind of everybody's money's within the mutual fund. Comparing them to ETFs, they tend to be less tax efficient. And then again, on mutual funds, you're looking at what the expense ratio is.
What the expense ratio is on that, because again, does that make sense? And then of course there's annuities. There's a whole slew of different types of annuities, variable annuities, fixed annuities, index annuities, whatever. Again, all of this, what makes sense for you? That's the big question, which Tommy, I think leads into the next investing mistake, and that's working with the wrong advisor. One of the things that I do, that we talk about, is working with a fiduciary.
It's an investment advisor, a financial professional, whoever you work with, it should be your partner, because as you near and enter retirement, hopefully you're retired for a long time. It's not something that happens immediately or quickly. It is having that trusted partner to work with you through the full retirement process.
I'm really glad you said that, Tommy. I really do. And having a partner. I believe that, once again, I keep talking about this. You've worked hard for your money. I believe that you should be working with an advisor, not a salesman. Not a salesman, somebody that you can partner with. Because here's the thing. Do you believe in the philosophy of how, if you're going to hire them, do you believe in the philosophy of how they're going to manage your money? The strategies that they're going to pick for you, and the individual securities that you're going to own. The other thing too is which I pride ourselves on, is communication. How often do you meet with your advisor? Because again, this market changes, your plan may change with it, Tommy.
It's really important to establish that trust. It's not a blind trust. It's not just, yep, they told me this is the greatest thing, or yep, this is my plan. It's asking good questions, getting good answers, and making sure all pieces of your plan are understood and that everybody's working towards that same goal.
And then also, do you understand? Are they talking at your level? right? Or they just, or you know, because again, if they're talking over your head, it's like, oh, you know, I don't understand what you're saying, because here's the thing: if you don't understand something, you shouldn't be doing it anyway. Does that make sense? I mean, that's the way I feel.
Seems reasonable.
That's the way I feel. So that's why it's so important to be working with a team, somebody you trust. And I also encourage everybody to interview. Go talk to other planners, because you need to find a home, a place that you are comfortable being at. That's what I encourage, because we want everybody to feel good about their overall plan.
Yeah, I think that about sums up the 10 investing mistakes we've been through today.
Well, I thought it was great information that we provided, and hopefully our viewers, got some nugget out of it, some nugget. But you know what? The thing is, Tommy, I think a lot of people are seeking help as well too, because again, we've talked about it. That's why we offer that 15-minute retirement review, which I think has been extremely helpful, where people can ask us questions about this topic or maybe any other topic you may have, whether it's your 401k plan, Social Security, you name it.
Yeah, and we also offer out on the website, we have different in-person or online classes available going across a variety of topics if people would like to get more information that way.
That's exactly right, Tommy. I mean, that's why we're doing this show. We are here to help you, guide you, give you the tools that you need so that way you can make an informed decision. I mean, we're doing this show every weekend. Our goal is to get you retirement ready. So be sure to catch us next time right here on Retire Vivid.
Do you have questions about your retirement plan, or do you want to know if you are on the right track? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to make retirement vivid. Schedule your 15-minute retirement review today.
Cameron McCarty and Tommy Breitbach are investment advisor representatives of Vivid Wealth Management, a SEC-registered investment advisor located in Des Moines, Iowa. Investment advisory services are offered through Vivid Wealth Management, LLC. Insurance products and services are offered through Vivid Tax and Wealth Advisors, and individually licensed and appointed agents. Tax planning and preparation services are offered through Vivid Tax Center, LLC. The preceding entities are affiliated. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Case studies and examples presented are hypothetical and used to demonstrate a concept. These studies do not represent actual clients or results. Similar or even positive results cannot be guaranteed. None of the entities above are affiliated or endorsed by the Social Security Administration or any government agency. Information expressed does not take into account your specific situation or objectives and is not intended to provide investment, tax, or legal advice. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Investments involve risk and, unless otherwise stated, are not guaranteed.
Thanks for watching Retire Vivid. Want to see more? Like and subscribe to our channel to stay up to date with exclusive Vivid content. Plus, be sure to watch our show Retire Vivid every weekend. We're here to help you get retirement ready.